Over the last couple of months, a handful of major US banks have sent out messages to their clients about key shifts currently taking place in the economy. JP Morgan, Bank of America, and Goldman Sachs have all warned their clients about the shifting macroeconomic landscape, some of them indicating that the odds of a recession have increased substantially, one that could impact not just the United States, but the entire world. As the old saying goes, when the US sneezes, the world catches a cold. We're going to break down exactly what these major US banks are telling their clients and what it means for the global economy and markets. Let's start with the message that Bank of America sent out to their clients. This is one of the largest and most influential financial institutions in the world. And in a private note, their top global strategist, Michael Hartnett, said, "Sell the first rate cut." The Federal Reserve, the US central bank, has been either raising interest rates or keeping them stable for the last 2 years. Hartnett is suggesting that when the Federal Reserve starts to cut interest rates, something that hasn't happened since March of 2020 during the COVID recession, it could be a sign that the economy is in deeper trouble than many realize, potentially also heading into an economic recession. They point out that the stock market, for example the S&P 500 that you see here, has surged ahead of the potential Fed rate cuts, with stocks up 32% in the last 9 months. This is an unusually high performance. According to them, the average increase that stocks see before the Federal Reserve cuts interest rates is about 2%, going back to 1970. But the real danger for stocks comes when the Federal Reserve begins to cut interest rates, especially when they do that before a recession, like in all of these instances here. Stocks decline by an average of 6% in the 3 months after the Fed begins to cut interest rates. Now that may not sound like much, but keep in mind that this is an average performance. In some cases, like in 1974, the stock market dropped by 30% in the 3 months following the first rate cut. Now the question is whether there is any evidence that the Fed is actually going to cut interest rates anytime soon. That's where the Bank of America argues that the central banks around the world have already started to cut interest rates, which is often a sign of a weakening global economy, which will eventually push the Federal Reserve to do the same. Indeed, this chart here shows the number of global central bank rate cuts at any given moment. You can see the last 2 moments which saw the highest number of rate cuts from the global central banks were in April of 2009 and May of 2020. Spiking to 76 and 92 rate cuts respectively. Both of these were in the middle of severe periods of global economic weakness. Today, we've seen 35 global central banks cut rates. This is still much lower than COVID or the Great Financial Crisis, but it is increasing at a fast pace, potentially indicating that we are heading into a period of economic weakness like in these instances here. Again, if the economy is weakening, it's more likely that companies will be struggling to grow their profits. Lower profits is something that the financial markets typically don't like to see and can lead to market sell-offs. And indeed, Bank of America has also stated their pessimistic outlook on global corporate profits. They believe that the earnings of global companies are going to go from an 11% growth rate to a 5% growth rate by the end of the year. Now that may not sound like much, but that's a 50% drop in growth. And when we look at what this looks like on a chart, it's a pretty significant rollover in global earnings growth. Typically, this type of rapid rollover in earnings growth has additional momentum, which can take earnings growth into negative territory. That is especially true during economic recessions. Now, to be clear, Bank of America has not explicitly talked about negative earnings growth in their outlook. If earnings growth rolls over briefly but holds above 0%, which is a scenario where the global economy does not experience any economic downturn anytime soon, that would be a very constructive scenario for the stock market. Indeed, when we look at the S&P 500's earnings, for example, they have been climbing at a very rapid pace over the last couple of years, which explains the very strong performance we've seen on US stocks over that time period. During the last 3 recessions the US experienced, corporate profits came down, which caused the stock market to drop violently. Today we have a very different look to those instances. Bank of America believes at the very least that this rate of ascension will slow down to look something like this. But we do have evidence that many fund managers, on the other hand, believe that a recession is a significant risk to stock market earnings today. This is what fund managers perceive to be the biggest risk for the stock market as of August 2024. We can see that 39% of fund managers today believe that a recession is the biggest tail risk to consider, a bigger risk than geopolitical conflicts or higher inflation. This is a substantially different look to the survey from July of 2024, just a month ago. Back then, geopolitical conflict and higher inflation were perceived to be greater risks than a US recession by fund managers. One reason for this is that we've seen a significant deterioration in the labor market in the month of August. Something called the Sahm Rule was triggered, and it is supposed to be a flawless recession signal. This has raised concerns about a recession for many. This is what the Sahm Rule looks like. Every time that it crosses above 0.5%, you indeed see an economic recession materialize, either as that is happening or shortly afterwards. When the Sahm Rule triggers, it means that the unemployment rate is rising at a certain pace, and history suggests that when this happens, there is often further weakening of the labor market that follows. And today, we have seen the Sahm Rule get triggered for the first time since 2020. Of course, any indicator is susceptible to making a false signal, which was the case, for example, example, in 1967, when the Sahm Rule reached 0.4% and then turned back down, never triggering a recession. Anyone that was preparing for a recession in 1967 would have been left waiting another 3 years. However, if a recession does get triggered this time around, Bank of America believes that their clients are likely not well prepared to endure it. This chart shows us how invested Bank of America clients are in the stock market. Now, although their positioning is not as elevated as it was in late 2021, it is currently in the higher end of the range of the last 20 years. This means that many investors are likely exposed to downside risk in the event that a recession does materialize. Again, without a recession occurring in the next year, this high allocation to stocks could prove to be extremely rewarding.